Welcome back. Well, you've been seeing those flashes at the bottom of the screen, and they're coming in from the SBI banking conclave that's been underway in Mumbai. And very pertinent. I mean, this is an issue, a topic that we plan to discuss with our next set of guests. Right now, the RBI Deputy Governor is saying that bank loans to NBFCs have been growing at 30% for the past 2-3 years, and hence the fear of interconnectedness. And the Deputy Governor is saying that we're worried that every NBFC borrows from 40 to 50 different banks. Would not like to prescribe an upper limit to the number of lenders, but want banks to come forward with a solution. And I think this is what the last couple of months have thrown up, more regulatory measures from the central bank to ensure that the system doesn't become vulnerable to any sort of excesses, be it on the lending to NBFCs or simply lending to the unsecured sector, the tightening of regulations on the unsecured side that we've seen. Anil Gupta, Senior Vice President and Co-Group Head Financial Sector Ratings at ICRA, as well as Sanjay Agarwal, Senior Director and Head of BFSI at CARE is with us now. Gentlemen, thank you very much. Season's greetings to both of you. Great to have you on this chat. So let's really open with this. Sanjay, if we could get your thoughts in on the slew of measures and the commentary that we've seen from the Reserve Bank in the last few months in order to ensure that there are no excesses that get built up on the personal loan, the unsecured, the credit card side. Just your thoughts and whether you would expect more of this as we step into 2024.
Yeah, thank you, CNBC, for having me on the show. And in terms of the RBI moves to strengthen the sector, they've been slightly more proactive than reactive or than any situation on ground which warrants that. So if you see the credit growth, especially of the banking sector in the last 12 to 24 months, the average growth to the unsecured loans or average growth to the NBFC sector has been something in the north of 25% plus, whereas the rest of the banking sector has been growing at something around 12 to 13%. So these two sectors have been growing at more than double the speed of the other rest of the sectors combined. There is some reason to it in the sense that NBFCs form the large corporate exposures, whereas the rest of the corporate exposure is not increasing substantially. So to that extent, NBFCs get a leg up. And the unsecured personal loan sector has been getting a leg up due to a slew of measures governments have been taking over the past few years in terms of digitalization, the actuation of the credit information bureaus, and the India stack and all those things. And the customers have in terms of, let's say, the mobile apps and the ready availability of credit. And these are enabling the unsecured credit space. So in both these spaces have got a huge leg up in the last 24 months. So the regulator is slightly being more cautious, asking the system to keep in more capital and be more judicious in terms of exposure to the sectors.
Anil, have you done any analysis of the extent of slowdown in to the unsecured lending? We've already heard from the likes of Paytm where they're cutting back on low-ticket postpaid or low-ticket loans. So in the last, ever since the RBI has introduced these measures to clamp down on unsecured retail lending, have you done any analysis of the extent of slowdown?
Sure. So these segments, we expect that the bank rate growth could actually be shaved off by maybe around 50 to 100 basis point because of these measures. So let's say if you look at the December credit growth, the credit growth incrementally has been close to 15 trillion till December 1st, which is 16.5% YOY growth. But for the fourth quarter, we expect that this will slow down on an incremental basis, and the full year credit growth will be closer to maybe around 18 lakh crores or closer to maybe a 13% kind of a number. In absence of these measures, I think the credit growth could have been higher by around 14% for the banking system. But yes, this will have a slowdown impact. Similar to banks, maybe non-banks also, we have been seeing that the retail NBFC AUMs have been growing upwards of maybe 25% in terms of YOY growth. And this also we expect because of maybe the funding constraints or slowdown in the funding from the banks. This growth can also get moderated to by maybe to around 18 to 20% by financial year 24.
Gentlemen, good morning. We actually just had the management of Muthoot Finance, half an hour back, and they said that under 50,000 rupee loans, he used the word, has completely dried up. So they are seeing a lot of uptake because people want to take out gold loans, which is also smaller ticket size and it's easy in that sense. So yeah, I mean the impact is being felt. Sanjay, you want to come in? Are you already seeing it on the ground, as Mr. Muthoot told us?
Yeah, so what's happening is when you look at the unsecured lending space, it ranges from upwards of 3 to 5 lakhs, which is the domain of largely PSU banks and large private sector banks, to something which has come in very recently of 2, 5, 10,000 rupees, which is being led again by a lot of activities on the ground and by the buzz on the fintechs. Over the last 3 to 4 quarters, we have been discussing with various players, and they have been providing caution in terms of this set of borrowers. Because the issue is that if you lend 5 to 10 or 20,000 rupees, then you can't put in a collection force or the collection mechanism. So as soon as there is overdue, then the loans have to be written off. And that category had increased very substantially. So that is something the regulators had been telling the market that you slow down on that. And the players themselves are now wanting to go in for much more, let's say, cohesive sort of unsecured personal loans where they can put in the collection agencies and where they can do a better credit assessment. So the common buzz being used in the market is let's look at a duration risk rather than the credit risk. So the short-term personal loans of say 2, 5, 10 up to say 50,000 is something that the players are not very keen on taking ahead. So the approval rates there have gone down very substantially. And we expect that that category will get hit. And the other side is the NBFCs, which specialize on those loans. They themselves have now started facing problems from the lenders, etc. So it's a multiple thing which is building up. It was building up for 3 quarters, and now the regulator action has been very decisive on that.
Okay. Anil, a two-part question. First and foremost, for NBFCs, are you expecting any sort of a further squeeze in terms of availability of credit or maybe margins, because credit might be available but at much higher cost? Are you expecting that to play out at all in 2024? That's a question on NBFCs. And then on the other side, the unsecured side, is there any risk of delinquencies? Are your models throwing up anything that we should be aware of? Any red flags on asset quality on unsecured?
Sure. So the first question on the funding constraints, see, we have seen that banks do account for a major chunk of the, let's say, borrowings which the NBFCs do. And this has actually increased maybe in last 2-3 years. Prior to that, it was maybe closer to around 40%. So yes, if the NBFCs have to basically continue the growth, maybe they have to approach more of maybe debt capital markets, but debt capital markets may not be accessible to all kind of maybe NBFCs in a scalable format. So let's say it's largely a AAA and a AA plus kind of or at best maybe a AA sort of a market where you can get a scalable or a sizable funding from the debt market. You have issuances which happen maybe lower rating categories, but you don't get a very large ticket size, and the investors are largely restricted to maybe smaller, maybe HNIs or kind of maybe family offices or maybe some kind of a retail investors. So yes, these measures will have an impact in terms of funding squeeze, increase in risk weight for NBFC lending by banks. Now we are having a situation where possibly the liquidity is tight, and during last 2 years, when liquidity was surplus, giving out credit to NBFCs was relatively much easier in terms of maybe deploying that surplus liquidity. Now, as we are getting into tighter liquidity environment, possibly banks will also reconsider their lending decisions to NBFC, because their ability to per se jack up the rates, that is what we have to see, whether they're able to jack up the rates because of the risk weights. Till now, we have not been able to see a material maybe increase. Their negotiations are still being going on, but definitely with increased funding cost, reduced availability or appetite of the banks to lend to NBFCs, we should see some squeeze or tightness in the funding from the banks, and debt capital market, as I told, is not accessible to everyone. So this will spill over into maybe some sort of a growth constraints for the non-banks in the coming maybe quarters and years. Your second question on the delinquencies on the unsecured loans, the behavioral trend, let's say when we look at the delinquencies, that remains good. So as such, no spikes maybe in terms of delinquencies we would have seen across maybe a wider set of players. But again, we have to see this maybe over some period of time, because these loans, digital personal loans, are something which have been a phenomena for last maybe couple of years. And how these loans play out all through the cycle is something which we have to see. Because today the access of the credit has eased significantly because of these digital lending and apps availability. So really just to see how much the borrower is leveraging himself to, let's say, borrow from one lender
Right.
to repay, that is not clear. So the impact of this tightening possibly will be visible on the asset quality of the lenders, I think, in the coming quarters, when possibly the flow rate slows down in this unsecured loan sector.
Gentlemen, great to get that perspective from both of you. Thank you very much for joining us. It's a pleasure, Sanjay and Anil. And thanks for coming on here on CNBC TV18. Have a great New Year's. I mean, we're almost there. And of course, all the best of luck for 2024. From all of us here, it's goodbye on this edition of Bazaar. Thank you very much for staying with us. But Chartbusters will pick up on all the action in just a bit from now. Stay with us.